There are two related risks. One is that inflation might turn out to be more stubborn than it's already priced in markets. And the second is the background. And the background is that financial cycles have been turning. By that I mean that credit growth has been slowing in general and that asset prices have started falling.
Overall, the banking sector is much more resilient than it was just before the GFC. But the nature of the risks, have also changed, and we're facing, if you like, a different set of issues to do with the interest rate risk and with new players in the financial system, the non-bank financial intermediaries.
Hello everybody and welcome to the BIS's quarterly review for September media briefing. With me today are Claudio Borio, Head of the Monetary and Economic Department, and Hyun Shin, Advisor and Head of Research, along with the authors of the special features. Claudio, over to you.
Thank you, Jill. And thanks to everyone for joining us today. I will speak about the period under review, which runs from 1st June to 8th September. Market developments reflected investors' view on the macroeconomic outlook and its implications for monetary policy. The view priced in markets was a benign one, as the world economy appeared resilient and disinflation continued. Within this broad picture, differences across countries became more marked. The divergent prospects of the United States on the one hand and the euro area on the other were front and center. The strength of the US economy, the associated perception that high interest rates were here to stay, and a surge in government borrowing put upward pressure on long-term inflation-adjusted or real yields. This boosted long-term nominal yields to a post-Great Financial Crisis peak. At the same time, investors' conviction that the end of US policy rate hikes was in sight put a lid on short-term yields, which lessened the inversion of the yield curve. Both real and nominal long-term yields did drift upwards in the euro area as well, but considerably less, reflecting a weaker outlook. In the meantime, more stubborn inflation reaffirmed perceptions that monetary policy would remain tight for longer than in the United States. This raised short-term yields and culminated in a deeper inversion of the euro yield curve. Investors' perception of the policy outlook continued to converge towards central bank communication. That said, investors saw policy rate cuts already in the second quarter of 2024, while central banks have been more cautious in light of remaining risks to inflation. The markets for risky assets were buoyant. Stock markets extended their gains. In line with developments in bond markets, these gains were larger in the United States than in the euro area. Risk-taking was most evident in US corporate credit markets, where spreads compressed to low levels. The high-yield issuance picked up. Investors remained unfazed even as corporate bond yields reached multi-year highs, refinancing loomed, and default rates rose. By contrast, banks adopted a more cautious attitude. They tightened lending standards and increased their provisions for future credit losses. In part also due to subdued borrowing demand, bank lending growth was lackluster. Despite differences in macroeconomic and policy environments across emerging market economies, we observed that they had several developments in common. Short yields fell as the monetary policy stance began to turn, with most emerging EME central banks pausing rate hikes or cutting rates in countries with falling inflation. Risk-taking continued, with many EME currencies appreciating against the dollar and high-yielding currencies attracting capital inflows. In this context, the economic weakness in China and the strains in its real estate markets stood out, causing nervousness but no dislocations as the Chinese growth model adjusts. Financial markets appear to be priced for perfection, but financial cycles have turned and inflation could once again surprise on the upside. Risks may be less apparent, but they have not gone away. Finally, I'd like to point out three boxes in the overview of this quarterly. One is on margin leverage and vulnerabilities in US Treasury futures, and another on bank commercial paper spreads as indicators of funding liquidity in major currencies, both by Fernando Avalos and Vlad Sushko. A third box is on corporate balance sheets and monetary policy tightening by Miguel Ampudia, Egemen Eren, and Marco Lombardi. Let me now turn to Hyun, who will present the special features in this issue.
Thank you, Claudio. Let me turn to one theme that runs through the quarterly review, which is the funding of financial firms, especially banks. The events in March this year reminded us once again of the importance of bank funding stability. One of the special features by Peteris Kloks, Pat Maguire, Angelo Ronaldo, and Vlad Shishko draws on data from CLS, which is the key financial infrastructure at the center of global FX settlement. The authors combine data from CLS and our own BIS statistics to shed light on global dollar flows via foreign exchange derivatives. Being able to study FX swaps in key currency pairs and identify the type of counterparties involved, the authors find that US and Euro area banks provide dollars to Japanese banks and institutional investors. The sums at play are large, and understanding this ecosystem will be key to understanding dollar funding. In another feature, Brian Hardy and Sonia Ju examine shifts in bank deposits, broadly construed to include not only conventional customer deposits, but also repos and interbank lending. The focus is on the first quarter of this year, when the banking stress occurred. The authors find that deposits previously held by non-financial entities rotated into those held by non-bank financial intermediaries, or NBFIs. In this spirit, a box in the feature, co-authored with Iñaki Aldosoro, documents that dollar deposits in the United States shifted to money market funds in the first half of 2023, and in turn, money market funds increased dollar lending to banks headquartered outside the United States. In the third feature, Julian Caballero, Alexis Morin, Phil Wooldridge, and Dora Shah turned their attention to banks in emerging market economies. EME banks were largely out of the glare of the headlines in March, which raises the interesting question of how they manage their interest rate risk. The authors find that these banks tend to extend floating rate or short-term loans that have similar interest rate sensitivity as their deposits. That said, EME banks have been increasing their securities holdings, which they tend to value at market prices. Finally, the special feature by Matteo Aquilina, Andreas Schrimpf, and Karanfil Todorov studies the market for commercial paper and certificates of deposit, or CPs and CDs, which are important short-term funding instruments for the banking sector. Key investors in these instruments are money market funds. And in particular, US money market funds are an important source of short-term US dollar funding for European banks. Thus, tracking the aggregate CP and CDs shed important insight into overall dollar funding conditions for the global banking sector.
Thank you very much, Hyun, and we'll now open to questions. So I see a first hand raised from Philip Inman from The Guardian. Philip, do you want to unmute your mic and ask your question?
Yeah, hi, good afternoon. What's that last comment by Claudio? Was that a warning to central banks, the idea that inflation hasn't gone away, that it's still hiding there, it's still lurking and looking to come back? And obviously we've seen oil prices particularly spiking in the last week.
No, it's more a point made about the conditions in financial markets. It's not a statement about central banks. I mean, clearly, central banks have been very, very clear that their objective is to bring inflation down and that they will be acting accordingly. They have also said very clearly that their actions are data dependent. So far, so good. Inflation has been coming down. As we argued in the annual economic report, it's likely that the easier gains have already been banked. because of the changes in commodity prices, the vanishing of the dislocations in global value chains, and so on. And now, from here on, the task might be harder, what we call the last mile. But the statement is not really about central banks. They are aware of the possible risks. It's more a statement about whether financial markets are properly taking into account these risks. And as I said, there are two related risks. One is that inflation might turn out to be more stubborn than it's already priced in markets. And the second is the background. And the background is that financial cycles have been turning. By that, I mean that credit growth has been slowing in general, and that asset prices have started falling. So as we said in the annual economic report, what we have seen so far in terms of market disruptions or market stress has been associated primarily with the materialization of interest rate risk. But the next leg and the question is not so much whether it will take place, but how intense it's going to be, is the materialization of credit losses. And that's basically what's related to the credit cycle and the weakening in economic activity. And so at that point, the question is going to be how resilient the overall financial system is going to be in order to absorb those losses, and particularly how large and persistent those losses are going to be.
Thank you very much, Philip and Claudio. The next raised hand is from David Bentau from Borsen in Denmark. David, over to you.
Yes, thank you. Thank you for letting me ask a few questions here. Today is, of course, a pretty important day because today it's 15 years ago that Lehman Brothers filed for bankruptcy. And although I'm aware that the story we're writing here is for next week, I'd like to ask you, so some of the things that we saw after the Lehman bankruptcy was the severe dislocation, both to access to US dollar funding, and also that we saw the US commercial paper program that essentially froze completely over. So it's a tempting question to ask is how resilient are US access to US dollar funding and the commercial paper program today compared to 15 years ago?
Hello, David. I think that's a very good question. This is indeed 15 years from the failure of Lehman Brothers. We have to think about the changes that have happened since the global financial crisis. In particular, in fact, the period leading up to the failure of Lehman and the subsequent changes in the financial system. What you saw in the run-up to the GFC is a very, very large increase in the leverage of the banking sector, and also bank-like entities that actually had a lot of very high leverage with associated funding fragilities. And we know very well what happened with the shadow banking system that actually accompanied that. Now, what's happened since then, of course, is that that very high leverage in the banking sector was addressed in part by stronger regulation through Basel III. And in fact, what we saw during the stress in the COVID, in the early sort of COVID stress in 2020, was that the banking sector was actually very, very resilient at that point. It was really the non-banks that were at the center. So I think what that does show you is that leverage has come down, but of course, as the structure of financial intermediation has shifted, the nature of the risks have also changed. To a large extent, the very high leverage in the banking sector was very much addressed. That was mitigated, but the non-bank financial intermediaries, the market-based intermediaries, took on a bigger role. But I think what we saw this year was that even with a much more resilient banking sector, as interest rates rose, and as the interest rate risk, sometimes does get, does materialize due to, due to funding instability, that those risks will materialize through, for example, the failure of Silicon Valley Bank. So I think, in short, the answer to your question is overall, the banking sector is much more resilient than it was just before the GFC. But the nature of the risks, have also changed, and we're facing, if you like, a different set of issues to do with the interest rate risk, and with new players in the financial system, the non-bank financial intermediaries.
Jakob Bloom from Handelsblatt with a hand raised. Jakob?
I have also a question following up on dollar funding. In the most recent crisis, you didn't see swap lines between the Fed and the National Central Bank being used, but the FEMA repo facility. Can you comment on that? And do you know? Can you say something to the reasons why the emergency swap lines weren't used for dollar funding, but the FEMA repo facility? Thank you.
Which we can add. Claudio, do you want to give a brief response?
Well, I mean, very briefly, the extent to which you need to rely on the central bank swap lines depends on the intensity of the stress, and obviously the stress was easily manageable. Fortunately, and for some of the reasons that Hyun mentioned, I mean, there were and there are vulnerabilities within the banking system, but the banking system is in better shape than it was before the great financial crisis. Just one additional point on the funding, dollar funding, which obviously is a possible pressure point given the importance of the dollar as the international dominant currency and the huge amount of dollars that it's outside the United States. I think that one of the special features that you see today in the quarterly review, which in a way is a follow-up to some of the previous work that we have done on the FX swap market, tries to shed light on this opaque but very, very large source of dollar funding in the international monetary and financial system. And I think it's one further step in the direction of trying to understand better what is going on in that corner of the financial system.
Thank you very much, Claudio. I see a hand raised from Hugh Jones of Reuters.
Yeah, hi. Just to go back to the non-bank funding of banks that you saw the increasing trend earlier this year. Do you think this is a trend here to stay, that it's a permanent semi-substitution of the way banks were funded? And also, do you have a full picture of exposures like you do in the traditional bank funding?
Yes, thank you for that. I think on this observation that we have in the special feature on the shift from deposits held by non-financial entities to non-bank financial institutions. I think that's, if you like, so it's not that overall deposits shrank, but rather the identity of the holder, shifted. And what that tells you is that there was a shift in the claims held by, the non-banks, households and firms, whereby previously, where they were, while they were holding claims directly on the banks, there was a shift, as it were, to an indirect holding where, if they migrated to money market funds, for example, then the funding would come back to the banking system via the money market fund. So, there are these shifts in the channels of intermediation. You have to also remember that deposits as a whole, in aggregate, really grew tremendously since 2020. So it's not that we saw an overall decrease in deposit funding, but certainly it's true that with the stress we saw in the banking sector in March, there were some structural shifts. I think the open question is whether that's something that's going to continue, or whether that's something very specific to the events that we saw in March. I think given the nature of the stresses, I would put more weight on the second, that it's much more a feature of the events that we saw in the spring, rather than something that's going to be a long-run secular shift in the way that banks would secure their funding.
Thank you very much, Hyun. And another raised hand from Bastian Benrath of Bloomberg, please, Bastian.
Yes, hello. Thank you for taking my question. I'm observing that in recent interest rate decisions of central banks, it's become rather unclear whether they would go up or pause. And obviously that has changed compared to last year, where it was like very clear that everybody would go up, and the only question was like how far and how fast. Are you willing to give us an overview or an estimate from your side, like how far we are in the tightening cycle in the US and Europe? Or to put it maybe a little bit more pointedly, do you think current market expectations that we are at the end of the tightening cycle are right or not? Thank you so much.
Well, thanks for the question, but I'm pretty sure you're going to be disappointed by the answer, which is basically, we don't really make statements of that kind. But you've already given a pretty good sense of where things are. And for that, you only need to look at central bank communication. Now, the reason why central banks in the past, they could afford to give further, more forward guidance was because the direction was very, very clear. Given what was happening to inflation, they had the fact that they had to catch up. Now the situation is the risks are more balanced, and that has been reflected in the communication of central banks, and it has been reflected also in the way that financial markets are looking at the path for policy rates. But having said that, and let me just go back to what I said earlier, I mean, clearly there are still some residual differences between what financial markets are seeing and the communication that has come from central banks. And I think that probably the most important element in all this is the fact that central banks have clarified that their actions are data dependent. The direction is no longer as clear as it was before. The length for which they will have to keep interest rates high is not as clear as it was before. And therefore, markets have to adjust, and they have to factor in these possible risks so as not to be caught wrong-footed.
Thank you very much, Claudio and Bastian. I see a hand raised from Carlo Boffa from Politico. Carlo, if you want to ask your question.
Hi, thanks for taking my questions. The first one is on FX swaps. I just wanted to ask how big a fallout will Japan raising rates be? And if you have any idea about the concentration and geographic spread of corporates funding in yen. The second question instead is on brokered deposits. I want to know your opinion about how big a risk brokered deposits represent, and if they are mostly insured or uninsured, this deposit, and whether this can be used as a proxy for interbank unsecured lending. Thank you.
Your first question was the Japanese holding of securities outside Japan, for example, through various institutional investors in Japan that may be using the swap market. Well, I think if you think about that, that particular phenomenon, it's less the rate differences as such, but also how the hedging costs actually enter into that decision to go abroad. In a way, so as a first approximation, the hedging cost typically is going to depend on how high the short interest rate is. So, for example, if a Japanese insurance company is investing in U.S. securities or U.S. dollar securities using an FX swap, then the hedging cost, as a first approximation, is going to be the difference between the short-term rate for dollars versus the yen, for example. So it's not really the yield as such, but rather the short-term rates. And so there is no simple answer to how these things will change as yields change. But I think what we have certainly seen, and this is something that market commentators have also mentioned, is that as short-term rates in the US have risen, that means that hedging costs have also risen. And so in the last couple of years, in recent years, it's been much less the case that long-term Japanese investors have invested abroad. So So in that sense, I think the impact of monetary policy in Japan may not have a very large impact on that particular calculus. On broker deposits, I guess so here this is more on the interbank funding. I think as a general rule, the interbank funding market has really decreased in importance over the years, and in particular, it's much more the case that it's secured funding using securities as collateral. So in particular, the repo market, which has taken a much more important role. And so, I guess your question doesn't really, it's not really, one of the sort of major issues that I think we, would see as being a big, determinant that actually, would be a big determinant for, financial conditions currently.
And next question is from Anna Reitman from Securities Finance Monitor.
Apologies. It's actually Vanadium News and Opinion. So I write for a consultancy on the editorial side, and we do focus very much on the repo market. So I also have a bit of a repo market question. And so throughout the couple of the different features that you have, the repo market is mentioned. There is a look back at some of the market stresses that we saw. But then when we look at the spring, it kind of seems that the repo market was functioning well, which I think, considering the stress, is, I think I have heard from regulators that they have not seen anything tricky going on this year, although some of them are digging into it a bit more. And then we also had the Fed warning on the Treasury basis trade around that, which relies on borrowing in the repo market. And I suppose what I would ask is, the deposit funding feature, does that show the repo market working as you would expect it should? Is there any analysis you can give me of how you see these different things as you step forward to try to understand better on this opaque side?
Yes, thank you for that question. That's a very broad question, and let me sort of try and take parts of that. I think your question on the Treasury futures basis trade and the function of the repo market, that's of course a very, very important point. In fact, in March 2020, the basis trade and the functioning of repo markets was very much at the center of the stress event that we saw. Indeed, a few months before that, in September of 2019, we had the episode where the stresses were very much concentrated in the repo market. For those sorts of issues, I think the key issue is, what are the business models that underpin banks that actually draw on wholesale funding, and what they do with, for example, their reserve holdings, at the central bank, how that's actually deployed in their business model. And I think this is a set of issues that have to do with the possible stresses that could arise when something like the March 2020 event, were to happen again because of deleveraging episode, for example, when margins go up. What we're looking in at in the special feature on the broad, if you like, the aggregate numbers for repos and deposits is just to look at the channels of intermediation more broadly. I think there, although we're taking a fairly broad, cut on the deposits, it is, I think, fair to say that, as I mentioned earlier in an answer to another question, that there were some structural changes during March of this year, as there was a rerouting of some of the customer deposits via non-bank financial intermediaries, but certainly back into the banking sector. So I think that they are different types of questions. I think your question on the broad functioning of repo markets, that's of course a very, very important one. And needless to say, this is something that we're watching very closely.
Claudio, you want to come in and add something on that, please?
Yes, just to emphasize a point that Hyun has made. The two pieces of work in the quarterly review that you're referring to are looking at rather different aspects. The one about what we call deposits, which in our statistics include some more than what people would normally think of deposits. It's just trying to explain how funds are redistributed within the global financial system across borders, but also within countries. The second question or the second issue to which you have drawn attention is the Treasury futures basis. And there, what I would basically say is that we have not seen fundamental changes in the structure of the markets since 2020. And one of the reasons why us and others have been particularly interested in that type of trade is that trades that are based on high leverage and trades that expose market players to liquidity risks are the types of configurations that can generate stress in the markets. So, but and that's the spirit of the box.
Thank you very much, Claudio and Anna. So I see another hand raised, and I think it is Mark Jones from Reuters.
I just had, and I think you basically touched on it, the last one, to some degree, about the Treasury things you say, it's worth monitoring. Can you just give us, as you say, it's not the first time you've warned it, but is it kind of, considering the situation we're in now, is it worth monitoring more closely than it was before, or is there anything different that's ultimately changed?
I would not say that there is anything fundamental that has changed for the reasons that I mentioned earlier from a structural perspective. But of course, market conditions change, evolve, and that's precisely what institutions like ours or any institution which is interested in trying to identify possible pressure points in the financial system and how they evolve is supposed to do, and that's effectively what we're trying to do. And by the way, it is just to clarify. Although the various pieces of work that you've seen in the United States and us have come out roughly at the same time, they were not coordinated. So that goes to show how we are all very closely watching possible developments in financial markets, and how some of them, at least for some of them, there is considerable consensus over their possible implications.
Okay. One other quick question, if I can. In previous reports, you've warned us about the property market issues and it potentially being one of the next shoe to drops. That has seemed to have gained a little bit more traction in recent months. What's your latest view on that risk ultimately?
Very briefly, just a couple of points. Let me sort of make a distinction between the commercial real estate segment and the housing market. Commercial real estate, that's a sector which is facing headwinds both from a structural and cyclical perspective. And I think that conditions are likely to deteriorate further from where we are. And we could see some strains both among financial banks as well as non-banks. As regards the housing market, something which has been puzzling, at least for us, but I guess not only for us, is the fact that in quite a number of countries around the world, what we have seen is that lately house prices have actually stabilized or indeed started going up again. And then whenever that happens in a number of countries, the question is, well, what's going on? Especially what's going on at a time when the economy is weakening. So this is rather unusual. Now, of course, you can have many explanations that apply to individual countries, and I've heard quite a number of them. But the phenomenon is so general and is happening very much at the same time across borders that suggests that some common forces are at work. Now, exactly what those common forces are, or at least what the relevance of them is unclear. Now, some of them are structural, in which case they provide some sort of comfort. For example, I think one can argue convincingly to some extent that what we have seen post-COVID is a fundamental change in preferences, with people asking for more space because of the working from home. Another aspect, however, is more conjunctural, and I think it's worth reflecting on because it ties back to what I said at the beginning. And it is the fact that financial markets are seeing that the interest rate cycle, the monetary policy, the peak in monetary policy tightening has been reached. And this goes back to the risks that I mentioned at the beginning. That could well be the case, but the risk that inflation might turn out to be more stubborn than expected is something that we should not rule out. And if there is a fundamental common factor behind all the types of vulnerabilities that we see these days, is that they are, to a large extent, the legacy of a period of very low interest rates that lasted very long. And therefore, business models, trading strategies that were predicated on that assumption are particularly vulnerable to current conditions.
Thank you very much, Claudio. And I think that wraps up all of our questions.